And good morning and welcome to Saudi House for those in the room and those watching around the world. I'm John Defterios, former emerging markets editor for CNN, having covered the region of the Gulf for a good 30 years, so it's a delight to chair this session. And I'm delighted the fact that we're doing something extremely different in this session because there's a lot of noise out there on the Davos Promenade and within the plenary halls about the disruption now underway. So we're trying to take a pause and looking forward to 2050. Some of our panelists say that's far too long, but for those who have to manage economies like in the Kingdom of Saudi Arabia, they want to keep their eye on the prize and the building blocks of today and how they'll influence tomorrow, okay? We're going to do a 50-minute session. I'll try to allow for some questions in the last 5 or 6 minutes, but this is a panel that's been curated in a fantastic formula because we're looking at all segments of the economy and how you manage it. I'd like to introduce our guests. First, His Excellency Mohammed Al-Jadaan, who's the Minister of Finance for the Kingdom. His Excellency Faisal Ibrahim, Minister of Economy and Planning. Philip Hildebrand, the former head of the Swiss Central Bank, but is now at BlackRock. It's nice to see him. Great to see you, Geeta Gopinath, who's the Professor of Economics at Harvard and the former Deputy MD of the IMF. Ken Rogoff is the chief economist at the International Monetary Fund. We're heavily weighted in Harvard today because the bookend at the left is also a Harvard professor of economics. Can we give them a nice welcome to Saudi House, number one? Thanks. And I'm going to call on Professor Rogoff, which is really out of place knowing who we have on the panel, but I wanted to check in with Minister Jadaan and Minister Ibrahim on why you thought it was important for us to look down the barrel, not medium term, but actually long term, knowing what's actually unfolding as we speak here in Davos is quite a heavy tenor when it comes to tariffs. We have 2 major trading blocks threatening tariffs, the bazooka from the European Union. The President of the European Commission is speaking today. Mr. Jadaan, do you want to share your views on why you thought it was important for us to keep a very distinct focus here, and how do you take it in?
Thank you very much, and thank you everyone for being here, and I'll try to be as brief as I can. I think there are things that you could do in a year, and there are things that you could do in 5 years, but there are things that will require actually intergeneration for them to make an impact. And economies, and I can speak about Saudi Arabia, we need to be prepared for what's going to happen in 2050 and beyond, and prepare for it from now. There are, education, social issues, skill sets, and serious structural reforms that will need to take place in an economy that would require 10, 15 years for it to actually start making yields. And that's what we are doing here. The last point I would say is there are a lot of noise in the world, and people who are going to get fixated with the noise and get distracted from what really, really matters in their economy will fail. So you need to make sure that your foreign minister, in our case, deal with the noise, and people like His Excellency Faisal and myself and our colleagues deal with the economy and focus on what really matters for our economy and our people.
Okay.
And hence the session.
Yeah, it's terrific. Your Excellency Faisal, I think of you as Mr. Dashboard because you have the portfolio of the economy and planning. And I know you try to fine-tune the data that comes in and where you are today on the roadmap to 2030. And then that's just kind of a pathway to 2030 because you're looking to 2050. What insights do you want to share as you see us have this discussion for the medium and long term in the next 45 minutes?
Thank you, John. I must admit, I was a little scared what you were going to say after Mr. But, I think data is important. But to follow up on what His Excellency said, the reason we asked this question in this session is I don't think it's being asked enough. And if it's being discussed, even 2050 could not be long-term enough. Even if it's discussed, we rarely see, except in the case of Saudi Arabia, where the answers are actually reverse engineering towards things to do today. We saw that. The Vision 2030, we're talking about this yesterday here actually, has been sustained for 10 years. And we use the word sustained because it's not easy to make sure the momentum of such a transformation that is, yes, in of itself an outcome, but it's also a foundation for that outcome to continue. So being part of the global economy, even more integrated economy within the global economy, we see the value from other countries doing the same. And we want to understand why our view of, or our ability to discuss and understand what needs to happen is not translating into action. If you look at different regions, if you look at Europe with competitiveness, every region has challenges. We sustained the transformation because we identified a challenge, which is the need to diversify the economy, to grow it more resilient, and for it to be more sustainable. So as we're seeing the global economy evolving and witnessing shifts and shocks, there's an opportunity for us to say, let's shape it in a way that addresses what needs to look like in 2050, 60, and beyond.
Okay, for our global audience that's watching, if I may, with a quick follow-up, what happens after 2030? Because a lot of people think Vision 2030, you hit the brakes. That's clearly not the case.
So already, and His Excellency, I think, alluded to this earlier, we already started talking about what we need to see happen and realize. We're doing two things, actually. We're saying the next 10 or 20 years after Vision 2030, what kind of a transformation needs to happen and what kind of specific outcomes do we want to see. Vision 2030 is not about a process. It's mainly about an outcome that's desired. So what do we want to see? And at the same time, we're having a conversation about, over the next 4 years, what can we accelerate so we're in a better position to do that, especially talking about structural reforms, which His Excellency mentioned. So moving forward towards being more resilient, more sustainable, the private sector playing a bigger role, a leading, co-leading role, innovation and R&D being a bigger part of our economic activity, connecting and integrating with international markets, and the list goes on. And I think it's very exciting what we are working on and what we will hopefully together with the private sector deliver from now till 2030 and beyond.
Great. Thanks for fielding those, because that wasn't planned in our agenda today, but I want to get a sense where your heads were on this. I'm going to go to the far end to Professor Rogoff, and it's great to see you. Traditionally, when both of you and Geeta measure GDP and the inputs there, you have to adjust what goes into these figures, right? And traditionally, it was factories, labor, land, of the last 100 years of industrialization. How about these new drivers that we see today? We see the major AI players here. How do we measure productivity correctly? What will be the key drivers as we evolve, Ken? And then how do we factor those into the new growth, if you will?
Well, first of all, I want to thank their excellencies for organizing this session and doing something really different.
Yeah, it is.
I mean, I've heard people doing 5 years ahead, but it's really unusual to do this. Certainly, the old economy still matters because you need electricity, you need energy, you need materials, and I think there's some naivete in some of the AI. We're going to have artificial general intelligence tomorrow and no one's going to work and we don't need to do anything, and just thinking this is going to move blindingly fast forgets about all these bottlenecks, which you do need to take time to plan. And I wasn't planning to say this, but I have to say one of the most striking moments to me in last year's Davos was I was listening to President Trump say, the United States is going to be first in artificial intelligence. And the room, and then he goes, and to do so, we are going to double U.S. electricity production in the next 4 years. And I turn around and the faces of particularly the Europeans, I must say, turned white when they said that. But you need to plan these things out. I mean, exactly, you don't want to get there and have a bottleneck there. I think the thing which I haven't heard a good answer to, even for the next 5 years, but certainly for the next 50 years, is what kind of economy do you want to develop so that people can lead, fulfilling lives where they're more than just being given handouts and, feel some sense of agency in the economy. We have the World Bank reported there are another billion people coming into the global labor force over the next 25 years, 2050. And maybe 600 million in Africa, 400 million elsewhere, but what are they going to do? And obviously, Saudi has a very large young population, and thinking about, what they do, I think is a very important piece of this that we can take up here.
It's very interesting. Gita, if I may call on you, and I'm sorry for the informality, but just to speed things along here. Ken made reference to AI and technology and the measurements of it. I have two daughters that are 23 and 20, and the job market has changed radically. I'm sure you've heard this from your siblings as well. There's layoffs happening. The entry-level jobs, even when you have degrees, advanced degrees, are not there. So to Ken's point, how do we take advantage of that technology, the role of it, but to make sure it's not a destroyer as we roll into the AI generation?
Yeah, no, thank you. And also, thank you for having me on this panel. I want to make a point about the long term, and where we end up depends critically also on the path we follow. So I wanted to make that point that what's happening right now in the world in terms of the changes in globalization, in terms of tariffs, in terms of hits to institutions, all of that does impact ultimately where we end up. The great financial crisis has had very long-lasting effects in terms of both the politics and the economics of worlds around the world. So there is this path dependence. Now, let's project above and over that. In the case of AI, firstly, I think we can all agree that the potential seems immense. I think everybody seems to agree that this is the most transformative technological change in not just our lifetimes, but in many lifetimes. So this is big. That said, in terms of what the actual impact is going to be on the labor market and what it's going to be on productivity is still in the uncertain zone. So you do have a fair amount of uncertainty surrounding this. If you look at projections for the impact on productivity, you still have a wide range anywhere between 0.1 percentage point to growth on a yearly basis to 1.5 percentage point to growth on a yearly basis. Of course, very, very different. So we're still learning how this will affect the economy, how it will affect jobs. What are we seeing in terms of the impact on jobs? Again, very early days. There is some suggestion at this point that what this technology could play out like is in a way similar to some of the past ones, which is a hollowing out of the middle class, right? So you have a shrinking of the middle class, which is that you have the very high-skilled people at the top end who earn a lot more income and wealth. You have low-skilled workers, especially in services, because of the demand that comes from the high-skilled income earners. And then you have the middle class that is shrinking, and I think that's the risk. Now, unlike previous technological changes, of course, the number of jobs that are exposed to the transformation is just much higher. It's also in services. You see young people coming out of educational institutions at that entry level with good degrees from good institutions are having a hard time finding a job. So again, that's where we're seeing the impact over here. We'll have to wait and see how this all plays out. A lot depends upon the speed with which this adjustment happens. There's been a lot of adoption at the individual level, so people like you and I, very fast adoption. But at the firm level, like the organization levels, the company levels, it's been slower. So I think in a year or two, we will figure out how fast this adoption is happening and how this change can come about. If in a realistic scenario, we could see very fast adoption in many of these companies, because I'm talking to some companies over here who say that, well, we now have figured out how to benefit from it, then we could see a fairly swift impact on labor markets too. And just to keep in mind that this past year, many things have gone well despite the tariffs and the policy uncertainty. The one thing that has not gone well is the job market.
Okay. A very quick question to both Ken and Gita, and then I'm going to bring Philip into it and then come back to our ministers here. Don't we have like an elephant in the room after the global financial crisis, Gita, that you talked about, and then we had COVID-19 where the governments had to play such an enormous role, paying for wages and keeping restaurants open, that the G7 countries in particular are really weighted down by debt. And if you have this dislocation of AI, which makes the jobless situation even worse, when do we have the moment where it's not just about raising taxes in the G7 and put that burden on the middle class, Gita, that you talked about, but having a true, honest conversation with citizens saying we don't have the money to do these things? Are we going to be at that tipping point soon? Gita, do you want to start on that?
I think governments everywhere will try to muddle through, which is that they will announce stimulus policies. They will announce, because that's just what you do in it. When you're in a crisis and in a recession, there is no government who's going to come out and say, at this point, that's going to say that we're not going to spend. So the spending will happen. We will see interest rates move. There will be the consequences that, again, the next few years that will play out. But I think there will be a fast reaction. What we have to keep in mind is, again, after the last GFC, what we had was what we called a jobless recovery, which is that the economy recovered much faster than jobs recovered. And why was that? That was actually a classic case of what happens in a recession, because that's when you see the job losses from automation. You don't see it in good times. In good times, companies hold on to their workforce because you're making profits and you hold on to it. You have some shedding, but not on a large scale. A recession hits, that's when you have the shedding, and you don't see the jobs coming back because those jobs have now been automated. And the struggle then was that unemployment insurance was, it was supposed to be for a year, but people were unemployed for 2-3 years. And so they had to keep extending the duration of unemployment insurance, which is very consequential. If the same thing happens this time around, again, we could be in another jobless recovery. And this time, again, people may be out of jobs for a very long time. The system of unemployment insurance that we have is not ready to deal with very prolonged, persistent levels of unemployment.
Very interesting. Ken, quickly, and then I'll bring Philip in, please.
Well, I mean, I think eventually if things move in the direction that they're moving, there's no alternative to taxation. You need to be able to invest in people. You need to be able to provide health care and such to all the people who are unemployed during this transition. And of course, there's a lot of resistance to that. But it's hard to see how you can both have any kind of stability without having the government spend money. And if they're going to spend money, they're going to have to raise money. And no, to answer your question, of course, the debts cannot just keep going up and up like they have. Interest rates would go up, we'd run into trouble.
Okay, Philip, what's this mean for capital flows? So I'm going to use the example of sitting in the UK. We had a pretty tortuous budget. I think we had 350,000 high net worth individuals leave in the last year as a result of this squeeze. You look at the government of Saudi Arabia, very healthy surplus. It deploys a lot of capital for this build out on Vision 2030. GCC countries like the UAE, Kuwait, pretty well positioned. Where does the money go in this roadmap for the next 10, 15 years as a result?
Thank you, and thank you, Your Excellencies, for having me. It's, again, wonderful to have a long-term perspective. We have, of the $14 trillion that we manage, over 50% is pension money, basically. So by definition, when you're in that business, you kind of want to look at the long term. So I think it's wonderful that you're framing it this way. I think the capital allocation story is very closely linked to the macroeconomic issues that Gita and Ken both raised in the following sense. What happens next here over the next number of years is going to be very important in terms of where the capital goes. And simplified in a sense, there are two stories, and you've both alluded to them. One is that this technological revolution coming on the back of a lot of geopolitical disruption creates a kind of an enormous effect on productivity. So this is the theory that I think one of the tech guys said, AI is like the moment when mankind controlled fire. So there's new evidence coming out of the UK that they found some archaeological dig. They now think that was about 500,000 years ago, as opposed to what they thought earlier, 80 or so thousand years ago. If you get that kind of effect, you could have the kind of numbers that Gita referred to, where suddenly we have 1.5% of more growth. And that would then allow us to essentially break out of something that has been very persistent. I mean, Ken is my favorite economic historian in the world, but so he should really talk about this. But when you look at long-term growth trends in the US, where we have pretty reliable data going back 150 years, what you find is we've actually never broken out of the 2% range. Two exceptions, the Great Depression on the downside and then the recovery in the war on the upside. But apart from that, it's always been pretty much a straight 2% line. Now, you know, there is a theory here that this could be so significant that we could actually break out of this and suddenly we end up having 3.5% growth with an enormous productivity boost. And that would have very important consequences for asset allocation. That means valuations today are not necessarily stretched. It means inflation does not have to become a big problem. It means there is, you know, you don't necessarily get a debt problem that leads to much higher interest rates. That's a very different world from the story kind of repeated of the last 150 years, where despite all this, despite all the hype that we currently see, the productivity gains are on the lower end of what you mentioned, and we remain kind of stuck in this 2% growth range, in which case we're going to end up with, you know, lower growth, stickier inflation, almost certainly higher rates given the levels of debt that we have in most countries. So that's going to be a very, very different world for asset allocators. That probably also means that in that scenario, we should start to worry about equity valuations across most developed markets. And so I think we're in this kind of slightly uncomfortable interregnum period. We're moving from an old equilibrium to a new one. Geopolitics, we are in one, I think, in a period that historically will be seen along the lines of the oil embargo, the collapse of the Soviet Union, moments where geopolitics really matter. And then comes this big question of what happens on the productivity side. Are we seeing a moment where innovation itself is being innovated? And therefore, you get these very positive effects that many now start to bank on. And frankly, my reading of the markets is markets are kind of pricing some of that in, Geet. I don't know if you agree. You know, the pricing currently is on the higher end of your range that you mentioned in terms of productivity. So we as a fiduciary for our clients, I think our focus is very much on tracking anything that we can read, whether it's patents, whether it's, you know, what you see in medical innovation, to see which of these two worlds stylistically are we moving towards over the next couple of years. And I agree with Geet that this will be a story of the next few years. And then there's a second allocation question, and that is, and again, you alluded to it, who then gets the benefits in the positive scenario? At the moment, it's been mostly the kind of tech, you know, the hyperscalers. Historically, Ken, you would know this better, but it seems to me that typically these things, if they work, they get dispersed over time. It's not at all clear at this point if you're an equity within an equity allocation game, if you're an equity allocator, it's not at all clear who is going to be the ultimate beneficiary in the positive version of the story. So it seems to me this is, from an asset allocation perspective, an incredibly consequential moment the next couple of years to see where the capital is going to go. At the moment, I would say the inclination, and of course you can see this here when you listen to all the sessions, is that we're kind of buying into the story of the AI being a historic moment where things move up. Maybe one last point, Ken, and you should come in on this. I mean, if you look at history, so steam, railroads, the ICT in the late 90s, these other moments where you see these huge investment booms that drive up GDP, in the long term, they've never managed to break us out of this 2% range. And so the bar for the positive story to unfold seems to me, historically at least, is pretty high. But this is something I think where both of you have probably more thoughts.
Why don't you jump in, Ken, and then we'll come back to the ministers. Go ahead.
Well, I mean, there's cycles and booms and busts, but I think you're right that in the long run, these inventions have always helped people. They haven't been a problem. But there are two ways this one's different. This one's faster. It feels faster. Maybe it won't be, but sitting, walking along the promenade, looking at everything, looking at what we see in our day-to-day lives, it feels faster. And I would say second, it's substituting for humans in so many jobs compared to a few things. And you move the people who are driving the horse and buggies to cars, and this is just so broad ranging. The social implications are important, which brings us back to this session. You've got to plan for this. You have to think about this. Don't think this isn't coming.
Great, thanks for that. I'm going to come to Minister Jadon and bring us to the present, the clear and present. I've looked at the WEF Global Risk Report. Number one was geoeconomic confrontation. It actually was the highest mover year over year in the risk report. Number two was state-based conflict. And just at the start of 2026, we've seen quite a bit, right? In your neighborhood with Iran, it's simmered, but there's a lot of energy for change there. What is your role in government, do you see, and the actions you take now that kind of fortify or build resilience for the kingdom in this pathway to 2050?
Few things I think will need to be focused on, and I just wanted to make sure that we go back in the discussion on what is really the long term. How should we be prepared for 2040, 2050 and beyond? And we have taken a very clear, I'll talk about Saudi, and I think possibly Saudi can be a role model and the positive things that actually happened is focus on your economy and ensure that you do everything you can to resolve disputes amicably through dialogue. And actually, despite all the noise and the risk, the number one risk that you cited on the WIF report, there are 3,000 people gathering here because they actually are looking for the dialogue.
Well, it is actually, ironically, the spirit of dialogue, but it doesn't feel that way, if I can be candid with you.
This is why I'm saying you will really need to cancel the noise and focus on what really matters. And if you do, you can actually engage in a very constructive dialogue. My worry, and I will be very unpolitical on this, is in two folds. One is corporates are looking for the next quarter's results because that's what determines their bonuses and that's what their shareholders are pushing them to do. And a lot of countries around the world, particularly the democratic system countries around the world, are looking for the next election cycle and what will make them win. Not really what really needs to be done for the people of their countries in 10 years and 15 years and 20 years. They will not be accountable, they will not be there. In a country like Saudi Arabia, in a country like Qatar, in a country like the UAE, and where you have young leaders who know that they will be accountable in front of their people in 20 and 30 years ahead, they will actually look for what really needs to be done in 15 years, in 20 years, and in 30 years. That is the difference, and that's the message we are trying to put forward, is that we really need to prepare. We are citing and trying to ask our colleagues to give us insights, but we are also just, making the alarm very loud that you really need to look at this and prepare your people, your society, your economic structure for, in a large extent, unknown in 15, 20 years from now.
Good. Candidly, when you see noise like this with two major trading blocs threatening tariffs on top of each other, this bazooka to actually limit U.S. investment into Europe, what goes through your mind? And I'd love to hear the both of you, but Mr. Jadon?
I think very quickly, we saw this as recent as last year, and a lot of people thought that, the world is going to collapse and, we are going to die, and nothing happened. I think countries adapted, businesses adapted, people adapted. I think.
Well, we had a taco trade, as they call it.
Well,
too, yeah.
I think wisdom would prevail ultimately, and ultimately we will find a solution. But my key point for this session is let us just make sure that we are not distracted by the noise of today from what really, really matters to prepare our people and economies in 20 and 30 years to come.
Good. This leads me really well to His Excellency Faisal. What are the macro tools that you're using today on this roadmap to 2050 then to do what Minister Jadon was just suggesting here, to make sure you are fortified for the future. And I think you have to expect, I had Jerry Inzerillo from Doria talking about the demand for housing within the Doria complex coming from the east and the west. So capital flows are moving into the GCC and other faster growing economies. How do you prepare for this, if I can challenge you on that?
Sure. Maybe I'll just try to. I'm honestly trying to unpack the whole discussion.
It's pretty
that just
interesting,
happened.
so
It's
yeah, it's good.
Very, very potent. I'll try to comment on what I heard. I think, in general, the best way to deal with uncertainty is to. I mean, you have a choice. Do you want to deal with it as an economy with unlocked potential, or as an economy with a lot of lost potential? No matter what, there are things you can control and things that are out of your control. You're always in a better position if you focus, like His Excellency said, on fixing your economy, fixing your potential. Number two, I think this fragmentation, this shifts and shocks, group of shifts and shocks that we're seeing globally, we can either say and debate what it will lead to, which is fine, or we can either say we want it to lead to something else. And rather than the next globalization being about nationalism, fragmentation, isolationism, whatever, it can be about something that merges the best of both worlds, which is a potential. It should be a globalization that unlocks potential and helps economies through dialogue, through reform, through thinking long term to unlock their potential. Stronger economies are better for the global economy. And we have examples today of that failing to happen given all the changes and the risks. If you look at Europe and competitiveness, we care about this because it's an important partner of ours. And we think this is an example of something that can either depart from the old and think more, let's say, differently. I don't want to get into trouble. Or just continue doing what we're doing and then hope that the outcome will look different. As far as Saudi goes, we're unlocking our potential. We're continuously assessing, gaining feedback, and using that to change course as necessary. His Excellency keeps saying, important thing is not to have ego, and I want to double down on that. We don't have the ego that prevents us from saying, this was wrong, we need to do it this way, this was right, it's yesterday's baseline, we need to keep moving forward. Moving forward, I think key tools will be, generally governments don't have a lot of commercial sense. In Vision 2030, commercial sense was embedded in the process, and we're seeing that growing. So engaging the private sector meaningfully in infrastructure and other projects is very important. I think doubling down on policy first, policy precision, if you will, and more structural reforms. The recent announcement that made it easier for non-Saudis to invest in the Saudi stock exchange is an example of bold structural reform that we think is promising and telling of what will happen in the future. Same thing for foreigners being able to own land, freehold. We're not talking about 99 yearly in the kingdom with the guidelines, etc. Also another sign. So structural reform, and all of that should be coupled with wiser spend. Optimal deployment of capital is what we pursue to get better at. In the beginning, there was a catch-up period. We accepted loss leaders, etc. Moving forward, we want to be really focused on the return, optimal return that helps us achieve the kingdom's outcomes, desired outcomes.
Okay, very quickly, the conversation 10 years ago is that, oh, geez, the kingdom, they'll never get this diversification done. They're trying to move outside of oil. But I find it fascinating because tourism's picked up in a big way. You know, the contribution to GDP is big. You're reaching out into the mining sector. You're sitting on $2.5 trillion of assets as well. Can you pull these off? Because I think your non-oil GDP is already above 50%, right?
So non-oil activities today represent 55, 56% of total real GDP. The degree to which they rely on, indirectly also, on oil flow, or let's say oil revenue, has gone down from 90 to 70%, 68%. And I mean, that's a milestone to acknowledge. It doesn't mean that our job is done. We need to continue moving forward in that direction, asking some deeper questions like at what cost? Was there a better way to achieve this? How much is the private sector driving this, etc. So we can have a more sustainable, I'd say, flow or momentum.
Great. Thanks for taking the
I
question.
would say
Go
this,
ahead,
John.
Phil.
I travel nonstop, and if you look at the changes in any particular country structurally, it's incredibly impressive what's happened in the kingdom. I've been coming, I think, Faisal, for 12 years now. Others have gone longer, but during that period, it's extraordinary, right? The only comparable sort of example in my experience are the countries that were severely affected during the financial crisis. So Greece, Portugal, to some extent, Spain, where you had bailout programs. That's where you see kind of similar degree of structural change. So it's very, very visible.
Okay, very good. For Geeta and Ken, where should the state set guardrails versus accelerate certain markets, whether picking winners or losers? You want to start, Ken? This is a key question for our two ministers.
Well, it's absolutely a key question, and you can't have the invisible hand work without some skeleton. I mean, you need some regulations, you need some laws, you need some framework, and thinking about that balance. I don't think it's, just does the state run everything or does the private sector run everything? It's much more like providing some rules and regulations and guidance. I think I will say that's been failing in the United States with respect to AI, where the guardrails have been abandoned to a large extent, from copyright law to intellectual property rights to all the problems that are coming, safety. All these things have been cast to the wind, and I think that's going to come back to bite us. And but going further into the future, it's a big debate about the role of state. We probably are going to have a lot of inequality. We probably need some kind of basic income. That's going to require more state intervention. People aren't going to like it. Certainly people writing for conservative newspapers are not going to like it. But I don't really see another stable equilibrium. But again, coming back to my opening remarks, a real question is, how do we have people feel agency? How do we have people feel empowered, not just the super elite successful, but ordinary people? Is an incredible challenge for the state in laying out rules and regulations.
Good. And that wealth divide, Geeta, is growing wider in the G7. Do you want to talk about the guardrails yourself and your perspective, please?
Yeah. So again, in the spirit of this particular dialogue, which is about what will it take to ensure that we are growing well 25 years from now in 2050, I think what's going to be critically important are the institutions and being able to ensure that there are good institutions that survive the current tumult that we are going through. We are in an environment where we are certainly moving away from the rules of trade that we've had in the past. There are, questions of central bank independence. More and more countries around the world, I suspect, will start asking themselves whether they should also turn protectionist, should they also turn inward, should they also try and have more financial repression and keep interest rates very low in your country, or should they do all the kind of distortive policies that, that the major economies of the world are adopting? So I would say that the number one duty for responsibility for the state is to make sure that the institutions that they have built up over these years, and emerging and developing countries have actually done a terrific job of building up a bunch of institutions, inflation targeting central banks, financial regulation, which is another thing where you could end up with so much competition that everybody says, well, maybe we've had too many guardrails in the past. So keeping those institutions strong, it's a choice. I agree with Minister Faisal that this is something that it's a choice we have to make. We don't have to take the path that we're going down as something that's just God-given. We choose the kinds of institutions we want to have. Also on the international stage, Ngozi, who's the head of the WTO, will remind us that even now 80% of global trade is being conducted under WTO rules. So all hope is not lost. This is still a time where we could come back to to sound good institutions. I don't think we're going back to what we had before because there were issues with those. So some of these institutions will be renovated for sure. We need to have that renovation happen, but states are going to have to deal with that. And yes, again, in terms of implications for how states do business, the grassroots is going to be very important. This is something that Ken said. When it comes to implementing fiscal policy, so for example, if you want to do pension reform, which I suspect many advanced countries in the world will have to do, it's just not viable, the current pension model that exists. The only way you're going to make that happen is if you actually get grassroots support for it. If you shove it through, it's never going to happen. So more grassroots involvement in decision matters at the fiscal level are going to be important. And if AI is truly going to end up with most of the income going towards capital and away from labor, then the current tax structure that we exist will not fund the government because capital income taxes are much lower than labor income taxes. And so you cannot have the social safety net that exists with that kind of with the existing tax structure, which means that over time that will also have to change.
Very interesting. Wow. We have only 5 minutes left, and I wanted to follow up with your other hat, your International Monetary and Financial Committee work that you're doing on the international stage. You're chair of it. Geeta kind of alluded to this, and I was listening to a report on BBC World Service last night where there was a U.S. congressman who said, I'd like to have the UN exported from New York. I'd be happy if it broke up. And these were built post-World War II institutions, right? WTO, you made reference, United Nations, International Monetary Fund, where you both worked, the World Bank. How do you think they need to modernize? And are they worth protecting? Sorry to be so provocative, but if they're not ready to modernize and they're not ready for the AI revolution, what do we do with them?
I'll talk about the World Bank and the IMF, and particularly the IMF, since I chair currently the IMFC. First of all, I think the noise again in the last few years about, is the World Bank and the IMF still relevant to today's world, is really, really largely just a noise. Because in reality, it is almost every country around the world that turns to these institutions, either for support for themselves or support for their region. And I think in the last few years, the World Bank and the IMF has not been stronger than the last few years, seriously.
Now that's a different perspective. I haven't heard that one yet.
And that is evidenced by actual numbers. I'm not now really trying to sell both institutions. But that does not mean actually they don't need reform. And a lot of reform is underway. They need to refocus on their core mandate. And I think the stakeholders and their shareholders are pushing them in that direction to make sure that they actually refocus their efforts into their core mandates, be more ready to the uncertain world that we live in. And the IMFC currently leads an effort to actually look at what can we do with the IMF in terms of governance, in terms of quota, in terms of mandates. And there is quite actually interesting buy-in from the majority of the shareholders into actually doing that reform. But that does not actually mean anything other than reform that is needed for the future. But they are still very relevant. And the noise that we have heard, including from initially the US about reviewing their membership in various international organizations, and the announcement that was made a few weeks back about them withdrawing from some of the UN organization, does not actually say a lot about how they view the World Bank and IMF. I think they view them now strongly. They are committed. I've heard this directly from the US administration. They see the value to the US national security, national interest, that they maintain these organizations because they actually do a lot for the world.
Okay. Final thought. Your Excellency Faisal, I've noticed that the kingdom has actually leaned into the UN process. It has actually leaned into the COP process. You're very active on the International Monetary Fund. Any parting shots here, and whether we can keep the architecture of today, modernize it perhaps, but maintain the foundations, and how important is it?
I think, given the acknowledgement that we've always had a strong voice in the world of oil, energy, diplomacy, and foreign aid and assistance, and becoming, the outcome of this transformation is that we need to cover a lot of topics and a lot of areas, a lot of sectors in a very short period of time, and we need to understand what's good for us, but in the process we understand, we have a view, and we believe a strong, deliberate voice on what the global economy should evolve to. We can't dismiss multilateral platforms, and it's important to also be a voice of the reform of these multilateral platforms. They were designed for a specific outcome in mind. If the outcome changes, if the desired outcome changes, they should just focus on that. And we've seen the return and the value of these platforms, and we're committed to global dialogue, but also making that dialogue count.
Okay. Thanks very much for taking all the questions. That was a well-curated panel, but I had a lot of talent on the table. I think we could have gone another 30 minutes, but our time is up. This is part of the official program in WEF 2026, and that spirit of dialogue that we did talk about, which means that this session will be on top link, so you can take a look at it for further analysis in the future. We were hoping to take questions, but we covered a lot more than I was anticipating with this great discussion. You know who's on the table here with us, but can we give them a warm thanks for their time today? Thank you very much.